Hi, everybody, and welcome to the Billion Dollar Banker podcast. I'm your host, Nicole Perrone, Senior Vice President of Production here at CrossCountry Mortgage, also a real estate investor and entrepreneur, someone that's extremely passionate about helping loan officers succeed in this market, but also passionate about real estate, passionate about helping first-time homebuyers, investors, and partnering with people that are out there in market that are helping these folks as well. People that need insight and inspiration or need to understand what the reality is. I sometimes I'll look at major publications, YouTube channels, people that have a really big following talking about home ownership and talking about aspects of purchasing that just aren't true. I left a Twitter comment today to someone that said, Grant Cardone always talks about how you should go out there and buy a multifamily home, but what he doesn't say is that you need to have experience to buy one, and that's just not true. You don't need to have experience to buy a multifamily home. If you're a first-time home buyer out there and you're looking to buy a multifamily property, you can absolutely do that. And you don't need to have any prior landlord experience. As a matter of fact, you can buy up to a 4-family home with only 3.5% down if you plan to live in it with FHA financing. And there is a ton of updates that Fannie and Freddie just made to the amount of money that you can put down on a multifamily property. You can actually put down as little as 5% using conventional financing. So be very careful about what information you take in. If you're interested in home ownership or you're interested in acquiring real estate, this is a channel to subscribe to. And if you're someone that has information for our audience, either whether it be you're an entrepreneur or a real estate investor, or you're in a field or in a business that you just want to get your message out to people because it's an important one, please let us know, comment, or send us an email at nicole.perrone@ccm.com, and we would love to have you on the show with us. So today we're going to talk about a mortgage guide for real estate agents. And there's still a lot of realtors in the market. I know that there's a ton of news on what's happening. The reality is that we will survive these changes, these NRA settlements, and everything else that's going on out there. Realtors will persevere, and we'll get through this like we always have. And realtors serve a really critical part of the overall process of purchasing a home. I know buyers are kind of getting used to just clicking on Redfin and making an appointment, but trust me, you want to have someone that's experienced, even doing mortgages for as long as I have and understanding real estate in the local community as well as I do. I wouldn't buy a home without a real estate agent because they're the trusted professional. It's going to really help you with a lot of the questions you have and a lot of the logistics that need to get set up along the way when you're thinking about purchasing a home. So we're going to throw up on the screen here a little PowerPoint that's kind of going to walk you through how a realtor should think a little bit like a lender. And when you're thinking about your customer, kind of try to position this buyer for success. So many buyers are having challenges. There's setbacks. There's little things in between them and achieving home ownership. And if you can think like a lender and you can really focus on what's available, it can help you to pinpoint what the best avenue is for your customer to help them achieve home ownership, whether that be their first home, their second home, or an investment property. So if you're a home buyer out there and you're listening to this as well, this could apply for you too. So maybe you're someone that's interested in getting into real estate, or you want to be thinking that way as well. So this certainly can be information that you can listen to too. So you want to think like a leader, right? You want to think like someone that's managing the transaction. For many of you realtors, you do this already. You want to know the difference between CrossCountry Mortgage because we have 150 different investors here. We're not a place you're going to go to where you're going to get one set of products, one set of guidelines, one set of exceptions. We have 150 different investors that we work with. And while most of the financing we're doing is your standard agency, conventional, high balance, jumbo, FHA business, we have so many more options for clients when there are unique challenges that everybody has in their life. You want to know about mortgage terms, and you want to know how we can help you grow. We could grow together because that's the goal. The more homeowners that we help, the more that we grow with each other. So, when you think about thinking like a lender, when you're assessing your customer and you're having that initial consultation with them, you want to talk about their credit, right? You want to get an understanding about where their position is. Is it a higher credit score? Obviously mean better rates and more options, right? And when customers are thinking about what's their rate, it really depends on their specific criteria, right? If you turn on the news, you could see the average 30-year fixed mortgage, but until you do an application, you don't really know what your average rate is going to be or what your rate could be. You want to know how much does it cost your client to live each month, like the monthly survival number, the MSN as we like to call it. You want to know about their cash. After putting aside, let's say 6 to 12 months of, their monthly survival number, how much can they put down towards a down payment? And this is, I just want to pause here because this is when it's really important to start thinking like a lender, because as a first-time home buyer in today's market, and realtors, this, right? There are so many programs that are out there for first-time home buyers. You just take the state of New Jersey. I mean, every state has it. It doesn't matter what state you're in. There are grants for first-time home buyers if you earn a certain amount of income, where the state will give you money for your down payment, where you may not need to put down any money. And we're writing tons of these loans. It's not very difficult. It's very simple. You look at the county that you're purchasing in. If you're a first-time home buyer, it tells you exactly how much you qualify for if you make under a certain amount. And we've gotten into that in other videos, and we'll continue to talk about that soon. But if you're a home buyer out there and you're looking to purchase and you're like, wow, there's money that they're going to give me to put down on a home, that's amazing. Yes, there is. And I'd love to help you and show you how that works. My team is here to help as well. So how much can you put down, right? What do you have available? You got moving expenses, you got money you got to keep on the side. We need to consult with our customers about this. And realtors, I know many of you do this already and you do it well. Income, does your client have consistent earning? Like you want to know, is my client kind of in and out of employment? Did they just receive an inheritance and they're just kind of hanging out and they got a ton of money in the bank, but they have no income? What's their scenario? What do they do for a living? Take interest in that part of them and get to understand it better, because it'll help you kind of assess the roadmap on where they should go to get the best options. And then their debt to income ratio. The debt to income ratio, for those of you that don't know, and I know many realtors do, but it's your monthly debt divided into your monthly income. And typically the lower the DTI, the more financing options that you might have available to you. So, if you have, let's say, $4,000 a month in debt and you make $10,000 a month, that means your debt to income ratio would be 40%. So what makes up a credit score? I mean, a credit score, basically FICO, there'd be a trivia question to figure out if anyone knows what FICO stands for, but Fair, Isaac, and Company is what it stands for, just so you guys know. It's a 3-digit numerical evaluation ranging from 350, believe it or not, which I don't think I've ever seen anything below 500, all the way up to 850. Assessing creditworthiness based on credit history and current credit accounts. The score, along with existing debt and income and employment status, is a factor in the mortgage approval, right? So when you see an average 30-year fixed rate mortgage advertised at the best rate out there, it's traditionally for someone that has a 780 or more credit score. So if you go apply with a lender and then we run your credit and it's a 730, even though that's an excellent credit score, you're not going to get the same rate that you see the very best rate out there, right? It's going to probably be a little bit adjusted based upon your credit score. So, new credit, types of credit used, the length of credit history, the amounts owed, and the payment history. As you can see, the things that are the biggest weight on your credit, like 65% of your overall score, is the amount you owe and your payment history. And then if you look at the length of time, that's also a big component. So you could say here that you're looking at nearly 80% of your credit score is based on the length of time, the amounts that you owe, and your payment history. So the less you owe, the better your credit's going to be. And the better you pay, the better your history is going to be. So those are important factors to understand and to know and to talk to customers about. So anything over 740 would be considered excellent. 680 to 739 is very good. It creates ease in obtaining new credit. 640 to 679, you can, you can suggest kind of a second look for some lenders and may require some added documentation, but that's pretty good credit score. Agency credit score requirements go down to 620. So that puts you in the game. Like, don't let anyone tell you need to have excellent credit to buy a home, because that's absolutely not true. You don't. You can go down to 620 with conventional, as I just said, and you can go significantly lower on FHA. If you're a 639 and lower, it could be challenging. You may have some difficulty obtaining financing on the conventional end, but we do have options in the FHA and the VA world. So that's your quick guide to credit. But pay all your bills on time. Don't apply for too many new lines of credit. Don't max out credit cards, and keep your credit lines open. Don't close them. The other thing to think about, agents, you're showing clients for like a significant amount of time. I mean, I think the average time of buyers out there looking for a home pre-approved could be up to 6 months right now in this market. So having these early on conversations with them, especially first-time home buyers, which is a big portion of our market, is really important. Don't assume that people know and understand this information. 1 in every 5 Americans find errors on their credit reports. So credit mistakes could lead to disqualifications. Clients should be monitoring their credit scores because it can affect their ability to get a loan. So make sure you're signed up for some kind of a monitoring system that's really going to help you in ensuring that you're doing everything you can to make sure you maintain that credit score. And then when it comes down to this, and agents, we can provide you with something like this that you could give to customers. I spoke to a real estate agent, Tiffany, who's over in California in the San Diego market. And she says with every customer, she does like an intake form. And I thought that was such a great idea. It helps her assess what their needs are, where they're at today, and where they want to be. But, how much does it cost your client each month just to live, right? The rent, the mortgage, auto, student loans, credit cards, home, utilities. These are such really, really great tools for people to have. I mean, you don't just have to be a first-time home buyer to do this. All of us out there, no matter how far along we are, have a budget, we have a P&L, we have expenses that we manage, and making sure that we're constantly looking at this is important. So you want to take this total number, whatever it ends up being, you want to multiply it by 6, and you want to make sure you have 6 months of that or 12 months of that on the side for survival funds. God forbid anything happens, and that'll give you kind of your reassurance that you need, that if you do run into an issue, if something major happens, that you have the ability to survive that period of time. After putting down and putting aside those 6 to 12 months, how much can your client put towards a down payment, right? It shows you here for conventional government and jumbo financing what the minimum down payments are. And yes, we can go to 3.5% down on jumbo. There's criteria and certain lenders that do that, but important to know that that is an option. When you look at conventional financing, you can do as little as 3% down. Many people still have that misbelief that FHA is the best way to go. In all these scenarios, you could do 100% of your funds as a gift, which is big. So here's a tip from us. While calculating the down payments, clients should remember to include closing costs, and they can add up to thousands of dollars to the typical down payment. So usually somewhere between 2 to 5% of the purchase price of the home is what you should account for your closing costs. You may also want to budget for moving expenses, repairs, renovations, furniture, etc. That dog looks very happy, by the way. So here's just a quick kind of recap here of like what your closing costs would look like, a little bit more itemized. Your home inspection, anywhere from $300 to $1,000, depending on the size of the home. Your appraisal, $550 to $750. Your homeowner's insurance, which we all need, which you could pay either at closing or upfront, anywhere between $600 to $1,800. Your lender is going to have an application and processing fee that gets paid at closing. Could be anywhere between $1,000 to $1,500 on average. You're going to have title insurance, which will verify that there's no liens or judgments against the property. And you're going to have transfer tax, depending on what state you live in. Sometimes the seller will pay the transfer tax, and other times the buyer will, and sometimes it's split. So to assess a client's ability to make payments in the future, having conversations with them about what they do for a living, obviously we'll review recent pay stubs and tax returns for the last 2 years to ensure the income has been consistent and stable. Sometimes we only require 1 year or, 1 or 2 months of most recent statements. It's not always 2 years, but that's kind of like an industry average. If the income is variable or the client's self-employed or commission, that's okay. It just might lead to needing a further history or maybe a written verification of employment. So do they have consistent earnings? And if there's a job change, we want to obviously understand that as well and the components there. So clients in the loan process obviously should not change jobs if they can avoid it. Sometimes you can't. And we are required to ask about any gaps in your employment history. But it doesn't mean that it's out of the question to get a loan. It just means that we need to understand it. We talked about DTI before. This is the ratio, again, of your monthly debt versus your monthly income. Typically, the lower your debt to income ratio is, the more financing options you'll have available to you. So this is kind of like a little chart. And again, it'll go off of your gross income. So if your gross income was $10,000 and your debt was $4,000, again, your debt to income ratio would be 40%. But just to think about that in terms of like gross income, right? You still, that's, from your own perspective, you might not be comfortable paying $4,000 in a mortgage if you make $10,000 a month. You might say, well, shoot, after taxes, I'm going to have like $7,000 left over. That's not enough money. I'm going to need to, kind of curtail my expenses. And I always ask customers, what are you comfortable with? It might not be, we might approve you for more than what you want to pay. So understanding that is really important. Keep your ratio as low as you can. Really minimize expenses as you're kind of moving towards that purchase. And, the good ways to do that is obviously if you can increase your income, great. If you could pay off debt, awesome. Avoid taking on any more debt and postponing large purchases while you're kind of waiting to find something. That's really critical. And then getting pre-approved, right? So if you're a home buyer and you're looking to purchase a home, and realtors, this and understand this, but getting your client pre-approved as early on in the process is really critical. It's a simple calculation, a simple application of how much you can afford. It takes 10 or 15 minutes to complete. And one of the things that we're suggesting for all of our clients right now is to do a full credit approval. That means that we send in your whole file to an underwriter so that they can fully review that documentation and make sure that you 100% qualify for the mortgage. This way, agents, when you submit an offer, the seller doesn't have to worry about the mortgage contingency really, because they've already been approved by the lender. It's huge. So here's 10 key steps in the loan process to make sure we know about, and realtors make sure you convey to your clients. We're going to confirm income sources. We're going to check for other real estate owned. We're going to check for adverse credit events. We're likely going to review your last 2 years of tax returns, maybe just W-2s, maybe 1 year, kind of depends on the scenario. We also do have programs where you don't have to show us any of your income at all. We have all alternative income products. If you're interested in hearing about that, go check out our video on non-QM lending products. They're absolutely amazing. But when we're talking in terms of just standard conventional and government lending, it's usually 2 years of returns or 1. We're going to verify the cash to close. We're going to determine if gift funds need to be used. We're going to approve the loan and automate the underwriting system. And we're going to determine how soon the loan can be fully approved. We're going to check for any contingencies such as sales of a current residence, if someone's departing a residence and they need to sell it. And we're going to make sure the loan meets the terms of the offer and the property included taxes and insurance and homeowners association fees, etc. So the fast track approval was what I talked about. And I'm going to take a minute now, realtors, to talk about what the fast track approval can do and how we can pair it with something called a cash plus program. So a fast track approval is basically taking an application from a customer, gathering all their documentation and sending it into underwriting so they have a full commitment letter when they're shopping. This is going to help you stand out from the rest. If I was an agent in today's market, I would make sure every single person, every single client that I work with gets completely credit approved, or fast track approved as we call it. You can close as soon as 10 days after that when you get a purchase contract. So if you have a seller that's like, hey, I want to close quick, and that's an incentive for them, you could say as a realtor, hey, I have an offer in my hand from a customer that's fully approved. We don't need to worry about any mortgage contingencies. They're fully approved, ready to close. All we need to do is get title, appraisal, homeowners insurance, proof of deposit, the sales contract, send it in the lender, get this thing cleared, and move forward. So massive incentive there. But what we can couple that with is a cash plus program. What that means is what we have is a product where CrossCountry Mortgage will pay cash for the property that your customer is purchasing, and we'll buy it. We'll buy the house cash, and then we'll sell it back to the customer. There's an agreement. If you're interested in this, realtors, and you hear this, like, this is an insane way to make an offer. Imagine saying to a seller, hey, my customer is not only fully approved, but their bank will pay you cash. If for some reason they don't close in the next, let's say 21 days, the bank will actually pay you cash for the property, and then they'll sell it back to the customer at another time. It's an amazing program. There's really no tricks of the trade to it. I'm happy to explain it to you. Comment below, or feel free to email me at nicole.perrone@ccm.com if you want to know more. But it's a phenomenal way to kind of get through the system here. So basically turns a pre-approval into cash. There's no appraisal or financing contingency that you need to, zero. So imagine making an offer that way. If you're a realtor and you're not aware of this, this goes back to thinking as a lender. If you're not aware of this, then you could be doing a disservice to not only a customer, but yourself. So if you want to get your customers in on the Cash Plus, I'm happy to send them in. Our team is standing by. We're ready to help out. If buyer backs out of the house, it's still going to be purchased. So I can go through all the details, but this is the strongest way for you to submit an offer to turn a pre-approval into cash. More loans for more buyers. We talked about this before. We could do renovation financing, reverse mortgages, non-qualified loans, jumbo loans, conventional loans, VA, USDA, all of the grant programs that are out there. We quite literally can do everything that anyone could do. It's not if we can get the loan done, it's how are we going to get it done, right? So we're here to help you and partner with you. We have doctor's loans where you could put down 0%. If you're working with doctors, let us know. The non-QM loans we spoke about in another video, you should definitely go check that out. Bank statements and 1099s only to qualify. Asset qualifier loans, investor cash flow loans, foreign national loans, full doc loans with unique features. So for you agents that are out in the New York City market, condos and co-ops, that collateral, we are the Black Knights of the condo co-op business in Manhattan, in the boroughs. If you have challenges obtaining financing, we have a client right now today that was denied by a large lender. He's putting down 70%, but he wasn't able to obtain financing because of two reasons. Number one, the community, which is a big, fully approved building that we have, and it's half condotel. It's got commercial space and hotel management features, and this bank was just unwilling to do it. Didn't matter how strong the client was. We have that loan fully approved, and we're getting ready to close in the next few days. So if you're an agent in New York City, we should be talking. We should 100% be talking. I can help you to get more deals done in these complex condos and co-ops. We don't need to go through the do's. We can go through the do's and don'ts here, but obviously as a client, you want to inform us of any changes. You want to maintain the low balances. We just talked about that. What you don't want to do is quit your job. Maybe you want to, but don't. Co-sign for anyone. Transition from a current employer to self-employed. Not a good idea in the middle of purchasing. Apply for or close out any credit cards, max out credit cards, or start moving funds all over the place, right? A couple quick terms to know. An ARM is an adjustable rate mortgage. They're super popular in this environment because many people are speculating that in the next coming years, rates are going to be lower. So why take a 30-year fixed if you could fix it for 5 and get a better rate today and then refi? Annual percentage rate is your total cost of the mortgage, including the interest rate, points, and any other loan fees. The application fee is obviously, says it in and of itself. It's the fee for applying for a mortgage. You got your appraisal, your appraised value, and your closing costs. Cosigner, if you're going to get a cosigner on the loan, that's something that you could talk to us about. If you don't qualify on your own, we could get a parent, a friend, a relative, whoever to get on it with you. Credit report, we talked about debt to income ratio and down payment and equity. Escrow is where you're going to put your money into an escrow account at closing. That's going to be put on the side as a reserve for your taxes and insurance. Fannie Mae and Freddie Mac and FHA are basically the government agencies that buy loans from the secondary market. So we give you a loan and then we sell it to them and they give us our money back. And then most likely we will service that loan for you, or whatever bank you're using will service it for you. We talked about FICO. Fixed rate mortgage means your rate's fixed for the life of the loan. Your loan to value, if you hear that, that's basically the amount that your loan is versus the value of your home. So if you put down 20%, then your loan to value would be 80% loan to value. And then there's a bunch of other terms here that are pretty self-explanatory. Principal, interest, taxes, and insurance. That's your mortgage is all combined into one. Every month when you make your payment, if you have a principal, fully amortized loan, that means you're paying down a piece of principal and a piece of interest. Very popular today is interest-only financing. because people want to determine when they pay their principal. They don't want to be forced to pay it every month. And, private mortgage insurance is one of those things too that's important to understand for first-time home buyers or anyone putting down less than 20%. If you have questions about any of those items, we could certainly talk about them. Usually lenders are going to lock your rate in for 30 days. And if you come back to us after you do your first mortgage, we're happy to help you out with a refinance and make sure we take excellent care of you. My name's Nicole Perrone. I'm the Senior Vice President of Production here at CrossCountry Mortgage, and I'm passionate about helping realtors and helping homeowners to get into homes. I love real estate. I love the market that we're in. I love the set of products that we have and the way that we can help customers. If you have questions, don't hesitate to reach out to me. Send me an email, comment below. I'm happy to stay connected to you. Follow us on social. We're always trying to post videos that are educational that can help you to succeed in any market. And we look forward to seeing you back soon. Make sure you subscribe below.